Hello everybody, my name is Birk. I'm an economist, and today we're going to look at some TikToks with some crazy statements about economics. Let's go.
Here's why I also think economics is a pretty bad major. First things first, economics back in the day used to be a very prestigious major. It's where all the smart kids went. It's very similar to how engineering was 10 or 20 years ago. But the truth is, unless you were targeting a finance role and you are in a liberal arts college with no business school and all they have is economics, I generally don't think it's really that great of a major. It's one of the most interesting subjects within the business world, but it's almost too theoretical to be useful in any sort of business context. I'll present two examples to illustrate this. So first, economics is the only field with two departments, one in the School of Sciences and one in the School of Business. The reason it's got two is because the economics in the School of Sciences is so impractical as not to be useful for business purposes. In the business school, it's not even a major, it's just supplementary classes. Number two, there's an interview out there of Jerome Powell, arguably the most powerful person in all of economics. In an interview, they asked him if his salary of $250,000 is fair, and he said yes. He controls the monetary policy for the entire United States and therefore almost the world. He's at the top of economics and he only makes $250,000 a year. Do with that what you want.
Okay, sure. So there's a lot of things to pick at here. It is true that economics is very theoretical, and theoretical stuff can be difficult to directly translate to a certain job on the other side on the job market. But there is a reason that economists are getting paid the big bucks. It's because the understanding you're getting from handling all of these different variables just brings a lot of thinking power. And you are being taught useful things, even though that specific thing you talked about in your lecture isn't necessarily going to be what you're going to be using at the other end. But this goes for a lot of different studies, and it's not isolated to economics. The other thing he said is that Jerome Powell is accepting and believes that a salary of $250,000 is fair, and because some finance CEOs are getting paid much more, that means that economics is worse. There is absolutely no way he could derive that. This could just as well be a personal belief of Jerome Powell. Jerome wasn't asked if some of the CEOs that gets paid millions of dollars every single year, if that's a fair salary. He is the chairman of Fed after all, so he would know that inequality is very, very bad for the average human in an average economy. And so it would make sense that his personal belief would be, we don't need people with that much power. And then that explanation makes perfect sense. So overall, I don't agree.
You are crazy if you think that the way you are going to get rich is from making the money that you have right now and just investing it in the stock market. That's insane. Why? Because what you are actually doing is you're just letting other people get rich. Who gets really rich? The asset managers who manage your money, the banks that hold your capital. Why do they get rich instead of you? Because what do? They take your money and they do something with it proactively. So they take your money and they take real risk with it. And I think unless you take risk with your money, but also with yourself, you're never going to get wealthy. And so you and I could go very viral on the internet every single day if we talked about how to invest your first $10,000 to get to $100,000.
Yeah.
I tried. You're not going to go viral.
You could get a lot of views on that, except it's totally pointless. And if what we really want to do is elevate people to real wealth, where they have enough money for all the things that they want in life, it's not done through investing. It is done through earning. That is the only way you make real money. Once you make real money, you can make more of it through investing. But in the beginning, you got to earn. That's it.
Okay, so a lot of different things can be said here. First of all, you should invest no matter what. Trust me, time in the market beats time in the market, and it really is a way to make a great foundation for yourself, even if you don't have a great income. Now, she has a point though. You need to earn money for you to invest it, of course. And so investing isn't the whole equation, it's one part of the equation, right? I'm not telling you that you can put in $1,000 and not have to work a single day in your life again. It's not that simple. She also has a point that you're probably not going to become a multi-billionaire through investing alone, especially not if you invest in indexes like most economists would suggest. But what really is the true meaning of wealth? I mean, if you want luxury cars and you want a huge house and something like that, sure. Use your money in a different way. Take some risk, start a business, do something. I agree. But for a lot of people, me included, wealth would be being able to retire and not having to rely on having a job that pays the bills every single day. In my private life, in my private economy, at this point, me and my girlfriend, we can retire at the age of 50. Now, yes, I would like to be able to retire next year, but that's not necessarily something that most of us can do. And then she made some statements with risk and doing something with it actions. Let's look at portfolio managers. How do they make money? Well, for most indexes or funds, the actively managed ones, even the passive ones, you are paying a little bit of money every single year. Often it's like half a point of whatever you're investing in costs. And that is, for instance, payment to the portfolio manager. And yes, a portfolio manager who gets 0.5% of, let's say, $1 billion, if he's managing that much, well, yeah, of course he's gonna get rich. The bank, yes, they are also gonna get rich, but they are making money from a lot of people putting in a lot of money and loaning out that money plus more. So it's not like they're taking risks that you're not. Quite the opposite, actually, especially for banks. They're taking very low risk because they are spreading their investments, every single loan, through on a lot of different people, millions of people. And so the risk becomes very, very small because even if I default on my loan, well, someone else is gonna pay it. So overall, I completely disagree. You should invest, please do it.
S&P 500, that grows at about 10% a year, 11%
True.
a year. So Let's imagine you've got your $1,000. Well, 11% a year, it's gonna take you a fucking long time to make any money, right? So it is not worth your time. Okay, then we go to technology stocks. NASDAQ does about 18% a year. Okay, that's starting to add up because these numbers compound after a while. It goes from 1,000 to 1,200, and then, it's another 20% on top of that, 20%. These numbers add up fast. Bitcoin, since 2011, been 145% a year, even with it falling 80% 3 times in the middle of that. So 145% a year, as long as you're in it long enough, okay, now that's really starting to pay off. And then as you get slightly more speculative, i.e. take a bit more risk in things, well, the returns go up, but they become riskier. So once you start moving into that world, okay, this is a whole different world now. Now, the guy with $1,000 can get rich.
I mean, he's not wrong. It's true, the S&P 500 has grown about 10 to 11% a year, while technology indexes has grown more and Bitcoin has grown way more. Yes, you're correct. But how do you know what's going to grow the next time? You see, it's very often that people like this, they view a trend. Let's look at the last 10 years and, so this thing grew way more than this thing. That means that this thing that grew more is going to grow more in the future. The truth is, that's not really how stuff works, sadly. Prior growth is not necessarily an indicator of future growth. Yes, you should have bought Bitcoin in 2011, but why didn't you buy it in the year 2000? Or in 1990? Or in 1980, right? You see, it's difficult to predict what stuff is gonna explode. Let's take Nvidia, for instance. One of the most valuable firms in the entire world right now just completely exploded with the rise of AIs. And listen, we have had AIs for a long, long time, but all of a sudden there came a scientific breakthrough. We invented transformers, which completely revolutionized language models. And because language models suddenly became way smarter, well, now we want to train them even more, right? Of course, it's a double-edged sword, right? They get smarter because of the transformers, but they also get smarter because of the data. And some people had to realize that. And all of a sudden, people find out, okay, GPUs are extremely powerful at training large data sets on for these AI models. And now all of a sudden, every firm out there that wants to build an AI needs to get these GPUs so they can train their models. But this is just like finding new land, right? Yes, it happens and it happens all the time, but you and I are not going to consistently go out and predict the next big thing. If we would, well, we would be very rich. So what he's saying is technically true, but it's realistically just bullshit. What he's saying is, just find the new big thing.
Well, just buy a Vanguard no load S&P 500 and hold it and don't ever sell it.
There you go. And the more money you have, just keep reinvesting and reinvest the dividends, and over time you'll do okay. Which is
right. Jordan Belfort, he is the real Leonardo DiCaprio in Wolf of Wall Street. And I mean, we're not going to watch the entire thing here. He just says buy an index, buy the S&P 500. And he's right for all of the arguments that I just made before.
I keep a lot in my bank account, cold cash there. Some people would argue with reason that that is not the smartest thing to do, but I do that because, again, my monthly income is so large that right now I'm not focused on making 5%, 10% of my money on an annual basis. Like I have more focus on just growing my monthly income right now.
Okay, so he makes a lot of money, but why wouldn't you want 5% extra or 10% extra? One doesn't eliminate the other. You can invest your money even if you are focused on making more money. That's why we always suggest passive index funds. You don't even think about it. You can even make an automatic transaction every single month when you get your paycheck. No problem.
The popular narrative is, for most people, the minute they get any decent amount of money is to buy your first house. And that's what people do. They take a 10% deposit or a 20% deposit, whatever it might be, and they buy a house. Why is that a poor investment? Why is that a bad thing to do? Because that does kind of sit counter to the popular narrative.
Well, we have to remember, first of all, where the popular narrative came from. In America, if you ask people what is the American dream, the answer is inextricably tied up with a single family home with a white picket fence. That's not an accident. That is the result of decades of messaging.
It is the result of the human nature. We want families, but we also want freedom. And freedom, for once, is deciding what you want to do with your own house or you're going to live with. A freedom you cannot have if you live in an apartment.
Some might call it propaganda.
Propaganda?
First of all, most people in the world do not live in single-family homes.
True, very true, especially in Spain. You can live like 10 people in a single apartment. It can be rough out there, but that doesn't mean that it's their preferences, now does it?
Like we do in America. That has caused a lot of issues, but to leave that part aside, this is how most people think about buying a house. They think, Grandma bought a house in Austin, Texas in 1970 for $100,000. Grandma just sold it 50 years later for $1 million. Grandma made $900,000. They go, it's the most profitable thing you could do, buy a house. I go, okay, that sounds really nice. Did Granny factor in how much she spent on maintenance for the past 50 years? No. Did Granny factor in inflation and how that affected her return? No. What's inflation?
Just to be clear, inflation is just you losing purchasing power. Your money gets worth less. And so if you invest in those 50 years that he talks about, well, that 10% or 8% or whatever percent return that you got, they would also have lost some of their value. So inflation is not strictly to houses.
Granny factor in the opportunity costs of what that down payment could have been used if invested in the S&P 500? No. And did Granny look at all these phantom costs such as interest on the loan? No. It's not simply the bigger number minus the smaller number. That's wrong.
I disagree. It is the bigger number minus the smaller number. You just have to factor in every single cost that there is. When you have a house, even if it grows the exact same rate as the S&P 500, well, you are not going to lose money because you would have to pay a pretty hefty sum every single month just to have an apartment to live in. It's called rent. When you own your own house, you're not paying rent. Yes, you're paying property taxes. Yes, you are paying interest on your loan, but quite often the interest on your loan plus the government tax is still going to be less or just around whatever your rent would be. And remember, when you're renting, that money goes to your landlord. Always. When you are owning, or let's say that you are paying back money to the bank, you are purchasing a tiny amount of your own house every single time you make a payment. So while it's true that some of your mortgage is rent, it's definitely also just paying yourself in the future.
That's wrong. That is simplistic. For the biggest purchase of your life, you've got to go deeper. Again, when I was living here, I kept a very close eye on real estate. And the place right next to me, same square footage, same number of bedrooms, same everything, it would have cost 2.2 times what I was paying in rent. So just to give you an example, if I was paying $3,000 a month, it would have cost about $6,400 a month to own. Okay. I said, you know what? I like renting. If I have a problem, I just text my landlord. I took the $3,400 I would have spent owning when factoring in phantom costs, maintenance, interest, taxes, all that, and I simply invested it. And I made more money doing that than I would have owning.
Okay, I don't think we need to watch more of that. I don't agree with a lot of this. I have made an entire video about buying a house versus investing in stocks, and you should go check that video, it's very good. Yes, it costs money to own a house, but the housing market has a tendency of rising. But it's all very dependent on where you purchase your house and what kind of house you buy. In Denmark, and also all of the cities in England that I looked at in my video, buying a house would be way more profitable, and it often comes down to one thing: leverage. And leverage is very, very powerful, right? Gearing. So when you purchase a house and it rises 5% in value, well, that's gonna be 5% of whatever the house was worth before. But your down payment would be way lower, right? Maybe 10%, maybe 20% of that. And so that 20% you put in, you just made money from this level, even though you only put this level in. That's called gearing. And of course, double-edged sword. If it goes the other way, you're gonna lose a shit ton of money. But on average, the housing market has a tendency of rising.
Every parent should consider buying a house for their child. I've said it before and I'll say it again. Every child that you have, purchase a house for them. Put a renter in there. Once that child becomes 18 years old, you have two options. You can sell that house, take the equity, pay the taxes on the equity, and pay for their college education. Or you can take that home, sell it, do a 1031 exchange, purchase a home in the college town that they're going to be living in, and then collect rent from their roommates. And then after they move out, you can sell the property. But at the end of the day, that can help you pay for living expenses and just build wealth.
I mean, sure, he's right, but I don't know a lot of new parents that has the money to purchase a new house for their child. A lot of people cannot even purchase a house, let alone if they can purchase the house, they cannot just purchase another because they're using all of their money to actually live and pay off that one house. What if you have two children? Would you then need two houses? He's right, sure, but again, we're living in this fairy tale land where you just have infinite money, right? That's of course not possible. What you can do, however, is start investing in their name. But that's another video for a different time, but there is a lot of tax benefits to actually get if you go down that route, at least in Denmark. Okay, so this was something new. This was Economist versus TikTok, and it was fun. It was really fun. If you have any questions, either for educational purposes or another video like this, drop them down below, and thank you for watching.